Welcome back to the channel, everyone. Today, we're diving into one of the most requested topics I've received all year: monthly dividend ETFs that actually protect your capital instead of bleeding it dry. You already know the covered call space is filled with funds that have great yields and terrible NAV performance. But two funds, SPYI from NEOS and QQQI also from NEOS, have done something different. Something the rest of the income ETF industry hasn't mastered yet: monthly income tax efficiency and, most importantly, zero NAV erosion over time. This is a 10-minute deep dive into exactly how they do it. We'll break down portfolio mechanics, tax strategies, options structure, historical data, long-term modeling, risk management, and realistic expectations for investors. Let's get started. Hello viewers, if you are enjoying this content and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. Most investors love the idea of monthly income. But most income-producing ETFs, especially covered call ETFs, are built with one major flaw: they sacrifice long-term NAV for short-term yield. JPY, JEPK, KYLD, XYLD, RYLD. They all fall into this category. High income, low or negative NAV compounding. So the question becomes, how are SPYI and QQQI avoiding NAV decay while still paying high income? Before we can answer that, we need to understand the structural issue. When an ETF sells covered calls on the entire portfolio, it caps upside. And when upside is capped, NAV does not grow. Over years, this leads to loss of compounding, flat or declining NAV, dividends paid out through capital erosion, poor long-term total return. This is where NEOS funds break the mold. SPYI and QQQI are not traditional covered call funds. They are options-enhanced ETFs, built specifically to avoid the classic pitfalls. Here's the secret. 1. They don't sell covered calls on the entire portfolio. SPYI holds the S&P 500. QQQI holds the Nasdaq 100. But instead of selling calls on 100% of assets, NEOS uses partial option coverage, laddered call structures, out of the money, OTM, option distances, active strike selection. This allows NAV to still appreciate, upside not to be capped, growth plus income to coexist too. They use index options, not stock options. This is extremely important. Index options settle in cash. This prevents share turnover, which lowers trading costs, reduces tax events, eliminates forced selling. 3. They incorporate tax loss harvesting and ETF efficiency. NEOS actively harvests losses during volatility. This allows higher distributions, lower tax liability, more predictable monthly cash flow, and it explains why their after-tax results consistently beat most income ETFs. Let's go deeper into SPYI. NEOS S&P 500 High Income ETF. Primary objective: high monthly income. S&P 500 growth, no NAV decay over time. SPYI holds the actual S&P 500 stocks, not swaps, not derivatives. How SPYI generates income without destroying NAV: SPYI buys the S&P 500. This anchors long-term growth. They sell selective S&P 500 index calls. Not too close to the money. Options are cash settled. No forced share sales. They optimize coverage to avoid overwriting, meaning they don't cap 100% of upside. Tax efficiency multiplies the effective yield. The result: SPYI has shown strong dividend yield, steady NAV growth, smoother drawdowns, better risk-adjusted returns than many covered call peers. This is why many investors now use SPYI as a monthly income replacement for JPY. Now let's talk about QQQI. This is the tech-focused version of SPYI. Holding the Nasdaq 100 means higher volatility, higher upside, higher option premiums, potentially higher income. QQQI uses the same NEOS playbook. Nasdaq stocks, partial call coverage, index options only, tax optimization, monthly dividends. But because tech is more volatile, QQQI tends to generate higher income potential, higher capital growth. QQQI has quickly become the growth income alternative to JEPK. Let's address the biggest claim: SPYI and AMP, QQQI show no NAV erosion because they don't behave like KYLD and XYLD. Here's why. 1. Partial coverage allows growth. When only 30 to 60% is overwritten, the remainder participates fully in upside. 2. OTM call strikes avoid constant assignment losses. 3. Index options eliminate inefficient share turnover. 4. Tactical call writing adjusts to market environment. 5. Tax loss harvesting boosts after-tax NAV. 6. They are actively managed. Not rules-based like KYLD. NAV erosion happens when you cap upside repeatedly over years. NEOS avoids this through strategic, dynamic option management. Let's talk about the hard results. Across periods of rising markets, volatile markets, flat markets, SPYI and QQQI have shown NAV stability, NAV appreciation, no multi-year decay pattern protection during high volatility. Compared to common income ETFs, NEOS funds behave more like growth funds that pay income, not income funds pretending to be growth. This is a critical difference. So, who should actually own SPYI and QQQI? 1. Monthly income investors, retirees or income-focused savers who want smooth monthly cash flow, no NAV bleed. S and AMP, P500, Nasdaq exposure. 2. Growth investors who want some income, QQQI especially fits this. 3. Investors replacing high-yield covered call ETFs such as KYLD, XYLD, RYLD, Dow Jones Industrial Average Income Fund, synthetic covered call products. 4. Long-term income growth portfolios, because NAV stays strong, income naturally grows alongside assets. Now, SPYI and QQQI are not perfect. They do have risks. Options income varies with volatility, yields are not fixed during extreme bull markets, income may be lower during extreme bear markets, NAV still declines like any index fund. They are not magic. They are simply better engineered. You also must understand, taxes vary by region. They are still equity-based funds. They depend on management expertise. Their option strategy can underperform in low volatility periods. Understanding these risks makes you a stronger investor. So, do SPYI and QQQI really deliver monthly dividends without NAV damage? Yes, when compared to traditional covered call ETFs. Yes, because of their unique option structure. Yes, because they allow growth plus income simultaneously. For investors wanting monthly income, capital preservation, equity growth options enhancement, SPYI and QQQI are currently among the best designed products available. If you want me to compare these ETFs to JPY, JEPK, KYLD, or other yield max funds, comment below and I'll make that video for you. Thank you for watching, and keep building your income future one smart ETF at a time.